Right, well, good afternoon. For those of you who don't know me, my name is Chris Beaumont. I'm one of the partners at Clive Owen, and today with my colleague and fellow partner Kevin Shotton, we're going to be going through the Academies Accounts Direction, which was released on the 31st of March, just in time for Easter, so a nice read over the festive period. Just a couple of things about housekeeping before we sort of start. Obviously, there's a question and answer thing at the top right-hand corner. So if anyone does have any questions that they'd like to pose to sort of Kevin or I, definitely just Kevin, I think it should be in this instance, then please just post them in there. If you've got any problems hearing us, or you haven't got to have the slides for any reason or whatever, then please just sort of put something in the chat, and my colleague Ben, who's alongside me today, will actually make sure that's dealt with accordingly. So we've now got sort of three documents. The accounts direction, 90 pages, the model accounts, Coketown, 69 pages, the auditor's framework and guide, another 34 pages. So in total, 193 pages, which compares to 170 last year. So at first glance, sort of an extra 23 pages of sort of narrative to have a look through. But if you strip out the sort of the front covers, the indexes, the introductions, some small little additions they've made, and obviously the repeat factor that's involved when you've actually got sort of three documents rather than one, there is actually not that much for us to actually go through today. So this will actually be a fairly short sort of webinar. First thing to sort of say is the accounts direction and the model accounts combined basically have the same sort of power as the accounts direction in last year. So effectively, under your funding agreement, you have to follow the accounts direction and the model accounts Coketown. There's no ifs or buts about that. That's what you have to do. So the fact it's now two documents rather than one doesn't change that guidance. In respect to the auditor's framework and guide, you might say, well, why is it a guide rather than direction? Because that's actually what we as academies are having to work to. Well, it's called a guide for auditors because obviously the ESFA are not the regulators of the audit firms out there. And therefore, all they can do is give us guidance around the true and fair view element of our audit report that we submit to yourselves. However, what as auditors we have to be aware of is the fact that in the engagement letter that we sign and you sign, actually, although the ESFA do not sign it, they are sort of party to it. It's what's known as a tri-party engagement letter. And under that, the regularity information included within this auditor's framework and guide is something, therefore, that we must adhere to and must follow. So if you're wondering why we're asking questions at certain points in time, you might want to sort of click into the auditor's framework and guide. So as I say, those are the three documents that have been issued at the moment. We do know that there's going to be a supplementary bulletin going to be issued. When, we don't know. It's obviously going to be sort of COVID related, and therefore, given the uncertainty we've had over the last year, it may be left until the last moment rather than being something that we get some fairly significant advance warning on. But it's probably going to be around sort of disclosures within the accounts, and particularly how sort of some of the computers that have been donated to the trusts are actually to be treated within them. So what are the main changes? Well, I'll start actually at the bottom of the list here. There's reduced technical jargon. So they've tried to put it into more plain English. There's a section on audit opinions, and it explains the different types of audit opinion. Most of the audit opinions that Kevin and I give are unqualified opinions. It goes through the various other types of opinion. But to be perfectly honest, if this is something that we had to qualify your opinion and give anything else but an unqualified, Kevin and I would be having a fairly detailed discussion with you. For those of you that are observant later on this year, though, you will see that actually the audit opinion or the audit report that we sign will look different in the 2021 accounts compared to the 20 accounts. There's more regulations coming for ourselves. We have to include more sort of guidance on certain things around sort of what work we've done on things like fraud. So the audit opinion will look different, but if it is anything else other than unqualified, as I say, Kevin and I will have a chat with you to sort of explain that in more detail. So I'm briefly going to go through the sort of trustees report before Kevin looks at the disclosures around the financial notes to improve, the governance statement, and then the increased disclosures around staff costs and income. So changes around the trustees report, and this is a theme that comes out as well in the governance statement, is it's all around sort of telling the story. What the Department for Education have realised is that your accounts are very complex because you've got Companies Act, you've got charity legislation, and then you've got all the ESFA documentation that's around. So normally a set of accounts for a similar size engineering company, say to yourselves, might be sort of 10, 15 pages long. Your accounts tend to be sort of 55, 65 pages long, with a lot of complicated numbers in there, talking about unrestricted, restricted funds, significant additional notes. And what it's trying to do is actually explain to a reader of the accounts who doesn't necessarily understand the numbers, actually what the significance of those numbers actually is. So it's trying to get you to explain actually during the sort of the last year, what has been the financial impact of the pandemic on you? Has it been a sort of significant additional PPE costs? Have you lost sort of higher income? But only if those costs on changes are significant to the organisation. It's also getting you to sort of think about what the risks and uncertainties are for the organisation. So you've all got risk registers out there. You've all got plans to how you're going to mitigate those risks. One of them may be the fact of pupil numbers are either going to drop or they're going to increase for certain factors. And it's explaining actually what the impact on the trust has been of those and what it's likely to be in the future. And also it talks around sort of giving a bit more sort of explanation around the significant numbers on the balance sheet. So fixed assets, obviously land and buildings, you can say a little bit about those, but it's probably those other numbers that change on a year-to-year basis. It might be that you're an organisation that doesn't get SCA monies, you just get the SIF monies on an annual basis, and therefore at the year end there is a significant accrued income for a SIF project, and obviously that will make that number significantly different from what it was in the prior year, and therefore it's just giving an explanation as to why that number has changed so significantly. Overall, though, as I say, it's telling the story, but trying to tell the story in a way that actually the readers will actually be able to understand without actually going into the numbers on the last sort of 30 or 40 pages of the accounts. And then the last thing it talks about you must do is identify any subsidiaries in deficits and talk around the steps that you're going to take to eliminate those deficits. There's also a short list of those things that you should do. So you should explain effectively the surpluses or deficits for the year and say how those have arisen. It might be, just pick up on an example I gave you a minute ago, around the fact that you've had a large SIF bid during the course of the year, and that's actually inflated your income, and therefore that's why your surplus is as significant as it is. It might be you haven't had any SIF income for a while, but actually you've got large depreciation going through because of the buildings, and therefore just giving an explanation of excluding those depreciation on land and buildings, this is actually what the underlying performance of the trust is. And it also talks about linking the funding sources with your objectives, so your GAG, your pupil premium, your infant free school meals, just talking a bit about the income source that you've got and how actually you've used that money throughout the year. And as Kevin will come on to in a minute, there's a little bit more disclosure around that. And then typically we've got investment policies and fundraising policies, which are reasonably sort of standard on a year-by-year basis, and not many of you do anything else on investments other than sort of keep monies with the bank. And as you'll appreciate at the moment, there's not a lot of interest to be gained from that. And fundraising in the last year, again, is something that you'll need to just probably put a little bit of thought into, because obviously in a lot of cases there hasn't been that much fundraising done in the way that has been before. So it might be that it's changed. So I will hand over to Kevin to talk about financial notes to improve.
Thanks, Chris, and afternoon, everyone. Again, I guess with the way the world's gone over the last 12 months, it's been a bit frustrating that we're having to speak to you across the medium of the internet again, but hopefully we'll be able to get out and see you all again shortly. So just following on from what Chris was talking about, so one area where there is, or there's more disclosure, goes into the trustees report, is if the trust is unfortunate enough to be in a position where they've got financial notice to improve Where that is the case for a trust, there are certain required disclosures that need to drop into the financial review, basically stating the period that the financial notes to improve in place for, providing a link to it with details from the ESFA website, explaining actions that are being taken or will be taken in order to remove that financial notes to improve, and if it hasn't been closed, the date the trust expects to be free from that. So then moving on to the next slide, we move on to the governance statement in particular. One area within the Accounts Direction, this area that the ESFA are focusing on, is where they feel there was a bit of boilerplating of disclosures. So obviously within the Corktown accounts, there is example wording, and the governance statement is quite a good example of this, where they give some suggested wording. And I think the feeling within the ESFA is quite often that wording is just applied or copied into a number of trusts' accounts without giving due thought to the trust's individual circumstances, and sometimes it doesn't fit with the numbers that follow. A few areas that have been highlighted that the ESFA noticed often aren't tailored to the trust circumstances. So any key changes in board composition during the year, any significant changes there, what the actual work of the board is, so what areas they're covering, focusing on, review of the effectiveness of the board. So whether that be a full governance review, whether it be a kind of skills audit across the board, and how is that effectiveness being considered. And then a couple of years ago, they brought the requirement in whereby if there's less than 6 meetings during the year, you have to explain why it was considered that the trustees have been able to cover all the appropriate trust business. So just setting out for whatever reasons that the board is satisfied they've covered up their duties. You know, and that can be because of the number of subcommittees and the reporting up through that. But just a reminder really that should be explained where it is the case. And then lastly, the last 2 points on there are all in relation to internal scrutiny or internal assurance, internal audit, whatever people want to put on it. So firstly, looking at how it has been delivered and what areas in particular have been focused on during that 12-month period, and the outcomes of those reviews. And then if there are significant issues that have come out of any of that work, what actions have been taken or what is proposed to put right anything that isn't working as before. Moving on to the final slide, we're looking at other changes within the accounts and where disclosures will change slightly. So first item on there, staffing disclosure. You might recall from the financial handbook last year that there was a change in that if you have certain key employees who are off payroll, so not on the trust payroll, in particular the CFO or the accounting officer, then you have to seek approval from the ESFA for that arrangement to continue. They've now, in the Accounts Direction, gone a step further on this. So there now needs to be within the staff notes disclosure of within certain key notes of the cost of those individuals. Now it just gets combined within the notes. So the key notes that are impacted are obviously staff cost disclosure, those earning more than £60,000 per annum, and the key management personnel note. But you will have to add in anyone who's paid, say, via a service company or on a consultancy arrangement into your staff cost disclosure in that area. And I think part of that is just to ensure that figures can be benchmarked appropriately if people are off payroll. So that whilst the authorisation from the ESFA only applies to those two key roles, the disclosure in the note applies to anyone who is off payroll and would be considered an employee. Then next up, in terms of income disclosures, there's more of an alignment here with what is disclosed in the AAR. So in the past, some trusts have disclosed a number of their other forms of income from the DFE and ESFA under a combined heading. So if you think about pupil premium income, infant preschool meal income, that has all been combined together, whereas in the actual account, the accounts return, the AR, they have to be separated out. So the accounts will now have to become more closely aligned with the AR, which hopefully will make things more streamlined and simple. In a lot of your accounts, we've tended to take that approach anyway in previous years. It won't actually lead to any difference in disclosure. But for some trusts who historically have amalgamated all of those grants, there will be a bit of additional disclosure in terms of splitting those out. Then there's a bit of a reminder in terms of leases and the fact that there's a different classification between finance and operating leases. And just a reminder for trusts to ensure they are comfortable with the classification. As a reminder, finance leases would be suggesting you would be taking on, in effect, ownership and borrowing alongside that, which obviously is a bit of a naughty word with the ESFA, whereas operating leases is much more of a longer term rental agreement. So just a reminder before trusts are entering into leases, just to consider the circumstances and how they will be classified for accounts purposes. And then lastly, on long-term commitments, there's potentially some additional disclosure on service concession commitments. Now, these ordinarily, these generally linked to some form of PFI contract. So if you think of school buildings that are PFI contracts, there's normally some link to the local authority there, and there may be other commitments, whether it be facilities management or various other streams. What the ESFA are asking trusts to consider is whether there is a commitment on the part of the trust there that needs to be disclosed within the accounts. For most trusts, this will be irrelevant and it won't impact on you. But certainly for trusts where they may have a PFI school arrangement, there may be something to consider there. And that, in terms of the key changes in the accounts direction, is it, as Chris said at the outset, there hasn't been a huge amount of change this year, although we do obviously await that supplementary accounts direction to see what that brings in terms of how they might want us to account for certain grants or assets that have been donated across to the trusts in the last 12 months. So that probably leads us on to the questions. Just a reminder, if anyone has got any questions, if you put them in the Q&A box. I can't see any in there at the minute. I can't believe you're going to let Chris get off scot-free here. This is normally the point where someone drops a question in that we haven't thought of, and we have to go away and think about it, speak to the ESFA, and then come back to you all.
Whilst you're possibly thinking about questions, just one thing to sort of say at the moment is we've been asked by a few of our clients about the Get Help with Technology program and how those assets should be treated within the Academy Trust's year-end financial statements. This was brought up at the last meeting I was at down in well, I was going to say down in London, but actually it was online for a change, as it has been for the last year. At the Academy Forum meeting, we sort of asked about this and asked whether we could sort of get any more guidance. And as Kevin says, this will probably be included in the supplemental guidance. But they did think one of the ways they were looking at it was possibly whether it was an agency arrangement, and therefore, in effect, you just need to disclose it in a note. But I must admit that seems rather odd to me. Therefore, I think what we probably will end up doing is bringing these accounts in as a donation and as a fixed asset addition. And therefore, what we sort of asked the department to do was, if they were going to go away and think about whether it's an agency arrangement or whether it's actually a donation, is to come back with some idea of costings. Because obviously, as trusts, you do not know what has been paid for these devices. And therefore, we've asked them to go away and either come back with an average price or some sort of price per a model, and then at least we can sort of come back to yourselves and sort of say, how many of these have you got? I know I had an email in from one trust this morning, and they've had nearly 900 devices. Well, if you say that's £250 a device, you're talking about £200,000 plus of a donation, which is obviously a fairly significant number. So just to let you know, that's an ongoing discussion with the department, and hopefully we'll get an answer on that. Still no other questions, so I'll just pick up on one other thing that I was going to mention, which is there's been a series of seminars recently around the use of APIs to actually get the AAR completed. And this is something that's been going on for a couple of years now, whereby Department of Education have been looking to try and get the information coming out of your accounting system and into the AAR at the year end. 2019, they worked with one supplier, which was Hogue. In 2020, they worked with Hogue and Capita. And for this year, they're working with Civica, Sage, Access, and PS Financials. Unfortunately, they didn't say this morning which Sage that was, whether it's Sage for Education, Sage Line 50, or whether it was just all of those programs. But it's something they're obviously looking at and trying to work through. You don't necessarily need to be on the ESFA's chart of accounts to actually use it. You can actually map your own chart of accounts to it. And they are talking about potentially 80% of the data being able to be transferred via this API from your accounting system into the AAR. Now, obviously, that does rely on your year-end financial statements, like your year-end data being accurate within your system. So that's something that Kevin and I will probably sort of talk to you about in due course when we're having our pre-year-end discussions, and just find out whether this is something that you're looking at using, or whether it's still you prefer to go down the older route of sort of manually inputting some of that data. But I say it's something that they're developing. The last ones I mentioned, the Civica, Sage, Access, and PS Financials, are ones they're working with, so they may or may not be ready for this year. And obviously Hogan, Capita, the other two that are working at the moment, are not one that are used by a vast number of trusts that we work with. So it's just probably a reminder that that's there. And as I say, Kevin and I will have some more discussions with you in due course.
We have had one question land, Chris, while you've just been explaining that there. So got a question just in terms of whether there's anything within the accounts direction or from audit forums that hint at possible changes within the upcoming financial handbook. I mean, the one thing for me that kind of jumps out, just to look at the changes within the accounts direction, is that kind of additional disclosure and encompassing any kind of off-payroll arrangements. It's clearly an area of focus for the ESFA. Last year in the financial handbook, they obviously meant they changed things so that if it was a key role, so the CFO or accounting officer, that had to be pre-approved by the ESFA, that arrangement. Whether they'll strengthen requirements further around that, the whole IR35 regulation is something that has been changing recently in terms of the wider world, and it continues to be a focus. So yeah, I don't know whether that's possibly something to come. Chris, I don't know if there's anything else you would add in different areas.
No, I think you're covering the couple of ones there that, Kevin, are being mentioned at the moment at the Auditors Forum meetings. The AFH is due out sometime in June, so the likelihood is we'll be either discussing this in person or discussing another webinar on the AFH in due course. hopefully we'll be seeing people in person to have some of the pre-year end discussions, and we'll be able to go through the impact, or at least potentially even put on a seminar. I'll wait and see on that one. Obviously we're watching government guidelines on these as they develop, so we'll come back to you in due course with what we can and can't do around the Academy's Financial Handbook seminar or webinar.
Well, I guess if there aren't any other questions, we'll just say thank you for taking the time to attend this afternoon. We will circulate. I think the slides have already been circulated actually, but we'll put the recording up in due course. And obviously, if anyone does have any further questions, then obviously give either myself or Chris a call or drop us an email, and we'll be happy to come back to you. But yeah, other than that, wish everyone well, and hopefully catch up with you all soon.